Okay, so part 2 goes into the payroll side of it. So we're going to be looking at payroll liabilities, and they're again part of that known liabilities section. So we know what they're going to be, but an employer has a lot of different expenses and liabilities from having employees. So these expenses and liabilities are pretty much one of the largest and can arise from salaries and wages earned. It can be from employee benefits that they're providing, or it can be from payroll taxes that the employer is responsible to pay. So if we look at how payroll is set up, and again, for those who have been working, you're probably familiar with this, but I just want to go through it step by step. So the amount that we earn from our employer, our gross pay, the pay rate they're giving us, right? That gross amount, the hourly rate times the number of hours that we're working, or the amount of salary they're paying us each week. That's our gross pay. But we always have deductions that are taken out of that, and those are typically some kind of taxes, or they could be voluntary deductions. After those deductions are withheld, then we get to what we call the net pay, or the take-home pay. So it's the gross pay minus all of the deductions. So our payroll deductions, they're also sometimes called withholdings, are amounts that are withheld from our gross pay. And again, some of it is required, some of it is a choice. So some of the required deductions are from laws or income taxes, like Social Security taxes also. Some of the voluntary ones we might see could be a pension or health contribution, life and health insurance, union dues, charitable giving, those kind of things. So those are things you have an option for in most cases. The difference after taking all those deductions out is going to give us our net pay. So one of the taxes that we have to pay are Social Security taxes. So they're the Federal Insurance Contributions Act, also known as FICA. And the law requires employees withhold these amounts from employees. Employers typically separate FICA taxes into two categories: the retirement, disability, and survivorship, and then the medical. So the Social Security is the survivor, disability, and survivorship, and then the Medicare is the medical side of it. So the first group, the Social Security system provides payments for those who qualify, right? So as we get older and we want to retire, if you've worked enough and you qualify, you will be eligible for Social Security income. It also is providing in case you were to become disabled. Those taxes are what helps to pay if you were to become disabled. You could still get payments. And then survivorship is also provided. If you had a spouse that passed away, you would be able to get their benefit if it was higher than your own. So the law requires us to withhold FICA taxes from each employer's salary or wages for every payday. The taxes for Social Security and Medicare are computed separately. So Social Security, as of 2018, was 6.2% of the first $128,400 earned in the year. Once you earn that amount, you no longer have to pay that 6.2%. And then FICA taxes Medicare is 1.45% of all wages. There is no limitation. So it doesn't matter what you make, you're still paying that 1.45% of your income that goes to Medicare. The other deductions are employee income taxes. So most employers are required to withhold federal income tax from each employee's paycheck too. The amount withheld is computed using tables that are published by the IRS or the State Department of Taxes. The amount depends on the employee's annual earnings rate and the number of withholding allowances that they claim. So allowances are going to reduce the amount of taxes that one is going to have to pay. The more allowances one claims, the less tax they're going to have. Employees are allowed to claim allowances for themselves and their dependents. A lot of states and local governments require employers to withhold income taxes from employees' pay and send them to them quarterly. But until they're paid they're a current liability on that employer's balance sheet. So that's why they're in this section. So we are withholding it every week. We're not paying it every week though. So we set it up in a liability account that we're going to pay out in the future. All right, with the voluntary deductions, again, there's a lot of different things it can be. Some of them union dues, which we say is voluntary, but a lot of times you're either required to be part of the union or you can't work there. So that's not always a voluntary choice, but sometimes it is. You might have money going into your savings account and the rest of your check going into your checking, so that will be distributed differently. You might have to pay into your pension, or you might have medical or dental insurance, life insurance, and then you might have charities that you contribute to, which they would withhold and they would pay it to those agencies for you. So these are all voluntary deductions that the employer is going to withhold from your check. They're going to set it up as a payable to pay in the future. Again, typically it's quarterly, to those people that you are asking to be withheld from. So here's an example of what it looks like. So we have a salary expense of the total amount the gross amount that we're paying the employee. And then we have all the deductions. So you can see that FICA Social Security was 6.2% of that $2,000. FICA Medicare, it's 1.45%. The federal income taxes payable they provided, that would be from a chart. The medical insurance would be a set amount every week. The employee dues are typically a set amount every week. And then that net amount, the difference between the gross minus the withholdings, gives us the net amount. That net amount we're putting into salaries payable until it's actually payday. When it's payday, we would debit salaries payable and pay out in the cash. So that's the employee taxes that we have to deal with. But there's additional taxes that an employer is responsible for. And that's what we're going to look at next. So the employer has taxes that they, as an employer, have to pay also. So remember when we did the employee FICA and Medicare taxes? That employer is required to pay the same amount that the employee pays. So the employee pays 6.2%, so does the employer. So every salary, 12.4% is being paid for FICA taxes for that employee. But the 6.2 is a tax that the employer is responsible for paying for. Same thing with Medicare. The 1.45%, the employer is also responsible for paying that same amount on that employee. So whatever the employee paid, the employer is going to pay the same thing. The other part that's involved is unemployment taxes. So there's federal and state unemployment. Because if they were to fire someone or lay off someone, they're eligible sometimes to collect unemployment. So because of that, that money comes from somewhere. So there's a federal amount and a state amount that are collected for unemployment taxes. So let's look at those. So federal unemployment tax is referred to as FUTA. State unemployment tax is referred to as SUTA. So for these, the federal government participates with states. They work together as federal and state unemployment insurance programs. Each state's going to control their own program, and they're going to provide unemployment benefits to people that qualify. The federal government is the one that approves those state programs, and they pay a portion of the administrative expenses because of it. The rates that they're charged is based on merit ratings. So if you have higher unemployment claims, you typically are going to have higher rates. If you have lower employment claims, you're going to have lower rates. So here we can see the employers, again, these are employer taxes. They're subject to a federal unemployment tax on wages and salaries that they pay to their employees. So 6% of the first $7,000 earned by each employee is the FUTA amount. Now with that said, because of the state amount, they give a credit up to 5.4% for SUTA. So the net rate for FUTA, the federal side, is 0.6%. looking at the state unemployment tax rate, it's 5.4% on the first $7,000 of wages paid to an employee. So if a state has lower unemployment tax rates, or they have lower claims, their ratings may be better, and that would give them lower SUTA rates, so they might not have to pay as much in the state unemployment rate. When we look at the entry for recording the employer side, so remember, we have the employee side, this is the employer side. So it's an added expense beyond the wages and salaries that we're paying. So it's a separate entry from the payroll expenses that we had for the employee. Now we have an employer one, and it shows us that we were using the same example. We had $2,000 recorded salaries expense from before. So that means the employees have not reached that $7,000 limit, so they're entitled. We're responsible to pay the full 6.2. I'm sorry, we're responsible to pay the full 5.4% and 0.6% on that $2,000. In addition, we're required to pay the same amount of FICA Social Security and FICA Medicare. So if we go back to the previous example, we can see that FICA Social Security and FICA Medicare were $124 and $29. The same amount is being paid by the employer at this time. All right, the next part goes into talking about internal controls of payroll. So because payroll is such a sensitive area, and you could have those people that take advantage of having access to payroll, you want to make sure that you have strong internal control. So we talked about that in a previous chapter, but we're just reminding you, when we think about payroll, we have to bring back those internal controls. So you have to make sure that we have different people that are doing the timekeeping than the ones that are paying it. The people that are preparing the amount should be different. So we want to have that separation of duties. It's really important when it comes to the area of payroll. All right, kind of switching gears a little bit. So if we have multi-period known liabilities, so we have things that we know that we're going to have over multiple periods. We want to make sure that we're recognizing those liabilities every time. So the examples they give here, they talk about unearned revenues and notes payable. So if you had unearned revenues, if you had Sports Illustrated that's selling a 4-year magazine subscription, it records amounts that are received for the subscription in unearned subscription revenues accounts. Amounts in there are liabilities, but are they current or long-term? Well, if it's over 4 years, it's really both, right? So the amount that's going to be fulfilled in the 1 year is a current liability. The rest of it in the remaining 3 years to be a long-term. The same kind of thing applies to notes payable. So we have to recognize if it's longer, there could be a liability that's over 1 year. That wouldn't make it all long-term liabilities. There's a current portion of long-term debt which will be included, and that would be for the part that is within the 1 year time period. All right, this is the end of this video. We're going to continue in the next video looking at estimated liabilities, warranties, and bonuses.